Under the surface, today's market reaction revealed something important about investor expectations. The rebound wasn't simply about investors becoming more optimistic. It was about reassessing whether last week's fears had gone too far. The bigger question now is whether this marks the beginning of renewed confidence or simply a temporary recovery within a more challenging environment. Today's market performance was surprisingly uneven. The Nasdaq gained 1.56%, powered by a strong rebound in technology and semiconductor stocks. The S&P 500 rose a modest 0.23%, while the Dow Jones actually slipped 0.15%. That tells us this wasn't a broad market rally. It was a concentrated move into a specific group of companies that investors continue to view as long-term winners. Meanwhile, Treasury yields moved higher again, suggesting markets are still adjusting to the possibility that interest rates could remain elevated for longer than many had hoped. Oil prices increased modestly, gold was largely unchanged, and Bitcoin gained more than 3%, reflecting improving appetite for risk. Perhaps the most notable signal came from volatility. The VIX dropped sharply, indicating that investors became significantly less defensive after last week's sell-off. The shift in sentiment was driven by several developments. First, geopolitical tensions in the Middle East appeared to cool after reports that Iran and Israel signaled a halt to attacks following diplomatic pressure. While risks certainly remain, investors interpreted this as reducing the immediate probability of broader regional escalation. That matters because when geopolitical uncertainty declines, money often rotates away from defensive assets and back into growth opportunities. At the same time, markets continue to digest recent strong U.S. economic data. Ironically, a healthy economy creates its own challenge. Strong growth reduces the urgency for the Federal Reserve to cut interest rates, meaning monetary policy could stay tighter for longer. So today's optimism wasn't based on expectations of easier policy. Instead, investors appeared willing to accept higher interest rates if corporate growth, especially in artificial intelligence, remains strong enough to justify valuations. Oil prices also stayed elevated, reminding markets that inflation risks have not disappeared and could still complicate future policy decisions. The flow of money today tells an interesting story. Institutional capital moved aggressively into technology, AI infrastructure, and semiconductor companies. At the same time, investors reduced exposure to traditionally defensive sectors, such as utilities and real estate, while materials also lagged. Yet this doesn't necessarily indicate broad confidence across the economy. Healthcare and industrial companies have remained relative leaders over recent trading sessions, suggesting institutions are still balancing offensive positioning with defensive exposure. In other words, investors are selectively embracing risk rather than fully committing to a bullish outlook. One interesting debate in markets right now is whether this renewed enthusiasm for AI reflects sustainable long-term confidence or simply bargain hunting after last week's decline. I'd be curious how you see this developing. Feel free to share your perspective in the comments. Despite today's recovery, several structural risks remain beneath the surface. Technology leadership continues to rely on a relatively small group of AI-related companies. When market gains become highly concentrated, disappointment from even a few major firms can create outsized volatility. Liquidity is another concern. Institutional positioning around AI has become increasingly crowded, meaning that if expectations change, selling pressure could accelerate quickly. Higher Treasury yields also remain a challenge. Rising discount rates naturally place pressure on expensive growth valuations. And while geopolitical fears eased today, higher oil prices remind investors that inflation could prove more persistent than expected. Perhaps the most overlooked issue is that today's rebound occurred despite higher yields, not because financial conditions became easier. That suggests the market's resilience currently depends heavily on continued confidence in AI-driven earnings growth. The broader message from today's market action is that investors were reassessing risk rather than abandoning caution. Confidence has improved, but it remains highly selective and heavily dependent on continued strength in AI-related growth. I'd be interested to hear how you interpret today's signals. Do you think this rebound reflects the start of a broader recovery, or simply a reassessment after an oversold move? If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior rather than just the headlines. Thank you for spending a few minutes here today. I appreciate you being part of the channel.